Here in number 8, we're going to talk about depreciation. Depreciation is one of the types of adjusting entries that accountants need to record at the end of an accounting period before they give out financial statements. These adjusting entries are needed in order to ensure the balances that are reported on the financial statements are properly reported. So in this one, we have the equipment that was purchased earlier that we're going to depreciate. The idea behind depreciation is we're trying to measure profit accurately. In order to measure profit accurately, you want to look at the revenues you incurred or generated in the period and then match with it all the costs. And when I say match, you want to expense all the costs that help to generate those revenues, so that when you get your revenues, you're subtracting all that was incurred in order to generate those revenues to get a good measure of net income or profit. So initially that equipment, the hot dog cart, was reported at $1,800, and we called it an asset because that hot dog cart had future usefulness, and at that point in time you could actually have gotten your money back. So it is an asset. But this asset, which has future usefulness, it will be reduced though as we use the asset. We're going to expense that hot dog cart as we use it. So we're going to expense it over the number of periods that that cart is going to be used to help us sell hot dogs and buns. How do you do that? Well, your management has to estimate how long they think they're going to use the asset, and in this case it's 5 years. They also have to decide whether they're going to try to sell it. In this example, we're going to assume that they're just going to give it away. So to figure out how much to depreciate per year, you take the cost of your asset, $1,800, and by the way, you would subtract any amounts you think you could sell it for later, and then divide it by the number of years you're going to use it. So if we use that hot dog cart for an entire year, you would depreciate $360 per year. You'll notice here this is just 30, and that's because in this example we're reporting monthly, so we don't want to record a whole year's worth of expense in 1 month. So we're going to take the 360 per year and divide it by 12 months to get the $30 per month. So how do we record it in the accounting equation? Well, what did we get? Well, we are getting use of an asset. When you use an asset, it's an expense. Now, the type of expense is called depreciation expense, which is the title used rather than equipment expense. Depreciation expense, what it does, like any expense, it decreases shareholders' equity. So we're going to reduce shareholders' equity for the amount of usefulness used. What is given up is the usefulness, or we're going to reduce the asset. Now you are actually not going to use the equipment as the title. We actually are going to use a different account title, and it's called accumulated depreciation. It's a fancy term, and what it is accumulated depreciation. It's called a contra asset account because it's opposite contra of all your other assets. In other words, it has a negative balance and it actually reduces assets. So when we record this depreciation, the effect is it's going to decrease our equipment by 30, but we're not going to decrease the equipment account directly. We're going to use this account called accumulated depreciation, and like I said, that's a contra asset, and that it makes assets go down. Now, as far as what's being recorded now, what's going to be on our financial statements is the book value, the net book value. And what that equals, it's your equipment account, which has the $1,800 minus the accumulated depreciation. Again, the equipment is at its original cost. We never touch that account because it's valuable information to know what the equipment cost originally. And remember that this accumulated depreciation is just an estimate. It's an estimate as to how long we're going to use it. So rather than decrease this actual factual $1,800, the true cost of that equipment, with an estimate, we put it in this account but they go together on the balance sheet. We report them on the balance sheet, and usually you'd see equipment, and in parentheses it'll say net of, and in this example, $30 of accumulated depreciation. What that net book value represents is the amount of usefulness left.